With so many real estate operators in trouble in 2026 and over the last 3 years, 4 years, many investors have stayed away from real estate, especially passive real estate investments, since 2022, really. And that is precisely what sets up today as arguably the best market for real estate investing in over a decade. So on that note, welcome to the Bucks Outside the Box show, where we challenge conventional money wisdom, get a little contrarian sometimes, and try to think, well, outside the box. Danny, how you doing today?
I'm doing pretty good. Doing pretty good.
Well, I'm glad to hear it.
Excited to discuss this.
Yeah. So let's dig into some numbers, because no one's going to believe our word for this, right? So let's dig into some actual real data and numbers. Prices crashed in multifamily. We're going to use multifamily just as a placeholder for the broader real estate market. Prices crashed in 2022 to 2023 by 25 to 30%. And you can see that in the Freddie Mac Multifamily Price Index, which we'll link to in the show notes here and show some of those visuals. It hit bottom in late 2022 and has very slowly started recovering since 2023. But that recovery is still in its very early stages, making today a great time to buy in and invest. Now, interest rates.
But Brian, with all this past history and whatnot, how should investors think about debt risk?
Well, so debt risk you can manage by getting fixed interest debt for longer periods. That is one of those things that you can and you should look at closely as an investor, whether you're an active investor or whether you're a passive investor. But, real estate deals tend to fall apart for one of two reasons. The investor or the operator either runs out of money or they run out of time. So, they can run out of money with negative cash flow, right? So obviously you want to be very conservative in the way you look at cash flow projections. And you want to make sure if you're investing passively in someone else's deal, you want to make sure that the operator is using very conservative projections for their pro forma. And likewise, you also want to protect against running out of time. And this is where a lot of operators, multifamily operators in particular, ran into trouble over the last few years, where they took on short-term bridge loans, often with variable interest rates, right? But these bridge loans often were expiring after 3 years. So they were forced to either sell or refinance or otherwise recapitalize the deal in a bad market for doing so. It's been a bad market for selling by and large, which the inverse of that is exactly what we're talking about today. It's been a good market for buying, right? But you wouldn't want to be a seller right now in multifamily or in a lot of other commercial real estate spaces. So, this is part of, what ties this all together is it is a good market for buying. And for passively investing, like you and I do every month in the co-investing club. But, deals fall apart because the operator runs out of money or runs out of time. So yes, you can mitigate that debt risk by getting, as low as possible fixed interest financing for longer periods of time. And, you do want to leave yourself flexibility to sell earlier too. So you want to be careful of prepayment penalties and so forth. So our next point ties into just that, which is that high interest rates have stuck around a lot longer than any analysts thought that they would. Going back, in 2023, everyone was saying, oh, you know what? Yes, interest rates are high right now, but they're going to come down within the next, 2 quarters, 4 quarters, whatever. And here it is 2026 and they're still high. So,
Right.
there keeps being a new reason to keep them high that nobody expected. So for example, in 2025, it was tariffs. In 2026, it's the price of oil shooting through the roof and driving up inflation there, which, of course, keeps interest rates high. So, there's been something new, every time that has kind of kept interest rates higher for longer. And that keeps cap rates up as well. And that's they move almost in lockstep, interest rates and cap rates for commercial properties like multifamily. And that high cap rates is good for buyers, right? I mean, so you say, oh, well, high interest rates are bad for buyers, but that's exactly why cap rates are high, right? Which keeps prices low for buyers. So those balance each other out. You get more cash flow for your dollar with higher cap rates, right? So that has also contributed to it being a good market for investing. Stalled rent growth has, this sounds counterintuitive. It sounds like, oh, shouldn't we want, as investors, shouldn't we want to see, rent growth, shooting through the roof? Well, not necessarily. So rent growth over the last 2 years has stalled in much of the country. And in fact, I was just looking at these numbers on Zillow this morning. So the average rent today nationwide per Zillow is $2,000, which is down $100 from a year ago. So the idea being that has, first of all, pinched a lot of operators' cash flow and forced distressed sales, which again, great for buyers, right? Creates plenty of opportunity for buyers.
I have to interject this here. For people my age and they hear 2000 is what it's been, when I remember paying 500 and that was the normal rent back in the day. And it's just crazy to hear that 2000 is a good
Is that
price.
when you walked, 40 miles through the snow uphill to school both ways?
Yes, those days. Uphill.
Yeah, uphill both ways. So stalled rent growth has also kept valuations lower than they would be if rents had shot up 5%, 10% over the last year. And it has also forced operators to use more conservative projections for their underwriting. If rents have stalled out over the last 2 years, and in some markets declined, and even according to Zillow, nationwide declined, you can't have operators who are trying to project 5% rent growth a year moving forward. That's just silly. No one's going to believe it, and no sound operator would do it. So it is forced.
And it's kind of a red flag if you're hearing them say anything like that.
Of course, yeah, absolutely. So it has forced operators to use much more conservative projections moving forward for rent growth, which is, again, a great thing for passive investors like us. And we've seen that in the deals that we look at in the co-investing club every single month. We have seen much more conservative projections and underwriting for over the last year or two because that stalled rent growth has kind of forced that, which is not a bad thing for us as investors who are buying into new deals now in 2026. And it's the same thing with cap rates. Those have stalled out too. Again, we were just looking at some of these numbers a few minutes ago. They've been hovering around 5.7% on average for multifamily nationwide for 8 quarters now. They're just hovering there. Now, the Iran war and the whole Strait of Hormuz situation, and with the oil going up, that actually might push cap rates up a little bit higher. It's still early in all that, so we'll see. But, cap rates have stalled too. And again, higher for longer. So we've also seen multifamily construction falling. So looking at the Census Bureau, at last check, new multifamily construction permits started at, or now they're at 427,000 units at last check. That's down from a peak of 767,000 at their peak.
Almost half.
Yeah. So at their peak in 2023, 767,000 compared to 427,000 today. So new multifamily construction is crashing downward, which is a good thing for new investors today. They're not going to face the same glut of supply that we've seen come on the market, or at least in a lot of cities, a lot of markets over the last couple of years, where that's been a big problem. And that's precisely why rents have been stalling or falling, by the way. It's that new supply glut coming on. And just to tie back to an earlier point of where you don't necessarily want to see rents just shooting upward. So when the national eviction moratorium ended a couple of years ago, rents had been stalling because of that, right? Because no one could enforce that. No landlords or property managers could enforce their leases. So then there was this huge, skyrocket in rents, which of course was unsustainable. And now over the last 2 years, we've seen the correction for that. But, this ties back to sort of a central thesis for this episode that we're recording, that you want to buy when there's blood in the streets, right? Like you want to buy when everyone else is kind of down on the investment and being like, oh, it hasn't performed well over the last couple of years, I'm going to stay away. That's actually the time when it makes most sense to invest, when it's been a little bit distressed, right?
Why is that?
Why buy when there's blood in the streets? Because prices are lower and better, and you're not competing with other investors for the same investments, right? Which drives up, or it drives up prices, drives down returns. So yeah, when rents are shooting up and everyone's really excited about investing in multifamily, that's setting you up for a correction like we've seen over the last couple of years, right? And that correction has largely been driven by the big supply glut because everyone started building multifamily, in the wake of those skyrocketing rents, which is not happening right now. So, most cities, or at least the cities that saw that big supply glut, a lot in the Sun Belt, for example, in Texas and Florida, they are working through that supply glut right now and absorbing that new supply, the new units that have come online over the last 2 years, and that are continuing to come online through 2026 and maybe to some extent early 2027. So, but the new housing starts for those and new permits, those are down precipitously. So, in the coming years, we will see a lot less new housing supply hitting the market for multifamily rental housing, which is good news for people investing in multifamily right now. Which, we look at multifamily deals every month in our co-investing club. We don't always invest in one. Sometimes we do industrial or mobile home parks or raw land flipping. But, we do often look at multifamily deals, whether we choose one or not to go in on together as a club. That's another story. Jenny, any final thoughts that you have about why 2026 is arguably the best market for investing in over a decade?
I don't. I think you did it great, but I do have a
All
question
right,
for
let's
you.
hear it.
If you could go back and tell your younger investor self one thing about investing during uncertain times, what would it be?
So, all right, I'll respond with a hypothetical. In the wake of the Great Recession and the housing crisis, that kicked off in 2008 and kind of bled through the next 4 years or so, would you, home prices crashed by 25 to 30%. Same number as multifamily prices have crashed over the last 4 years. Would you, if you could go back and buy residential properties, single family rentals, for example, in 2011, 2012, when they were at their bottom, today, would you do that? Would you go back in time and snap one of those up for half of its current cost?
Probably, yeah.
Yeah, of course, right? I mean, everyone would want to go back and buy it at that low, right, after the crash. But we are forgetting, in our time machine hypothetical here, we're forgetting what the news was like in 2011, right? Where,
Yes.
everyone was super negative about real estate. It was the whole blood in the streets thing, right?
Yeah.
Nobody wanted to invest in real estate because it had been nothing but bad news for several years about real estate. Prices had crashed, right? And everyone's super wary. Everyone's chewing on their fingernails. But that was the perfect time to invest. And that is really the
Right.
illustration here, is that you want to invest when fewer other people are investing, because that's when you can get the best bargains. And that's exactly what we've seen today with multifamily property prices crashing by 25 to 30%. Now, the reason that's not splashed all over the news the way that, single family home prices were back in 2008 through 2012 is that very few people actually own multifamily properties. So most people just aren't that interested in reading about it. Whereas a lot of people own homes, right? So, people were freaking out and, their hair was on fire back then about it. So anyway, on that note, if you got a fresh perspective out of this episode, subscribe to the show, pass it on to your friends and family and neighbors and second cousins twice removed. And if you didn't get anything out of the show, email us, support@sparkrental.com. Tell us what you want to hear more about. And lastly, consider joining us in the co-investing club. We get together once or twice a month to vet new passive real estate investments, hands-off real estate investments. We vet them together as an investment club, and we go in on them with much smaller amounts, as little as 25.
Which mitigates risk.
Right, exactly. We go in on them with as little as $2,500 per person, as opposed to the typical 50 to 100 grand that you need if you're investing in these syndications or funds or private partnerships by yourself. And if you are new to passive real estate investing, we have a free course all about some of the different options available, like syndications and JV partnerships and all that stuff. sparkrental.com/free. Check it out. It's 8 videos. They're all super short and sweet. And on that note, stay weird, unconventional investor.